we will probably skip over some slides that are relevant but not essential to what we're talking about today. So first we're going to take a quick look at the requirement to withhold, and then Form W-4, what's new for 2020, electronic W-4, state and local certificates, computations for the new W-4, and what happens with non-resident aliens. We'll take a look at some special problems, and this is a part that I'll probably be moving through fairly quickly because this is often covered in other sessions. But the IRS matching process, solicitation, verifications, penalties, and establishing reasonable cause, because very often that's part of what the W-4 is about, is getting that name and number from the person that you're paying and making sure that those are correct. And then we should have time for your questions. So leaping right into it, there is a requirement to withhold, and this comes up because way back in the day when we were in the days of the Wild West, Prodigy Classic on the internet and AOL and that sort of thing, we would, in our tax discussion boards for tax professionals and for helping other people, we would often get somebody coming in and saying, show me where it says in the tax code I have to have taxes withheld from my paycheck. And it's kind of a trick question. It usually comes in from tax deniers or tax protesters and things like that. But the truth of the matter is there is no place in the code where an employee is required to have tax withheld from their paycheck. The requirement to withhold is imposed on the employer in Section 3402A. And the employer has a duty to withhold, and the employer is liable for the tax, whether it's withheld or not, under Section 3403. 3402F1, prior to January 1st, 2020, this described, and it still does describe, the withholding exemptions or allowances for self, spouse, and dependents. And these were in effect before the Tax Cuts and Jobs Act of 2017. Before January 1st, 2018, these various exemptions were in existence, and the allowances were allowed for the spouse and self and dependents. And there was a standard deduction, single or married, and there were some other allowances that you could pick up as well. And the way the withholding was determined was based on the marital status, single, married, or married but withhold at the higher single rate. After January 1st, 2020, the exemptions, the tax exemptions, were suspended with the Tax Cuts and Jobs Act. They are still there, but they are set at 0, and they've been suspended until 2025. So we may see all this stuff come back again in a few years. The withholding now is based on annualized income and tax credits, and the marital statuses are married filing joint, head of household, and single or married filing separate. So we've got some differences there. Okay, just throwing in here and highlighted a few things to point it out, and you're welcome to read through this. I'm not going to read all of it, but the requirement to withhold: every employer making payment of wages shall deduct and withhold upon such wages an amount determined by the Secretary in accordance with the tables set by the Secretary, and so on. So that's where the tables come from, the requirement to withhold. The liability for tax in 3403 Internal Revenue Code, and then in the regulation, the employer is required to deduct and withhold the tax, and the employer is liable for the payment of such tax whether or not it is collected from the employee by the employer. Now, if you pay the tax and don't collect it from the employee, then that's additional income to the employee as well. So just kind of keep that in mind. But the employer is liable for that whether it's withheld or not. And if the failure to withhold, if the employer does fail to withhold, the employer will not be relieved of the liability for payment of the tax required to be withheld unless the employer can show that the tax against which the tax under Section 3402, which is the withholding, may be credited, has been paid. So if you can show that the employee paid the tax, then as an employer, then you're not liable for paying the tax that was failed to be withheld. So it's just very critical that things happen. Now, there's a description of the withholding allowances here in 3402F1. I've put that in as well. And again, you can read that at your leisure if you choose to. Code Section 151, exemption amount for purposes of this section, special rules, taxable years 2018 through 2025. The exemption amount means 0. Now, the reason they did that way is that the exemption amount is still there for other purposes. For example, determining when certain people are required to file tax returns, the exemption amounts are still in effect for purposes of those thresholds. For example, dependent tax returns and things of that sort. So for other purposes in that section B there, the exemption amount of 0 shall not be taken into account in determining whether deduction is allowed or allowable, or whether a taxpayer is entitled to a deduction under the section. So 3402F2, the allowance certificates prior to 2019, well, for 2019 and prior, it was called the Employees Withholding Allowance Certificate. And you use, if that form or a prior year form was submitted and the employee was paid before January 1st of 2020, the prior year form remains in effect until a new 2020 or later form is submitted. As an employer, you might want some uniformity, so you are allowed to ask for the new forms, but you cannot require the employees to submit new forms if they already have a prior year form in effect and they want to retain that. However, anybody who is paid, the first paid after 12/31/19, or any employee first paid after 12/31/19 by the employer, or any withholding changes that employees wish to make, those must be made on the 2020 form or later form. And it's no longer called the Withholding Allowance Certificate, it's called the Employee's Withholding Certificate. So its use is mandatory for people first paid after 12/31/19 or for any other employees who make changes to their withholding after 12/31/19. The withholding certificate is signed by the employee. It is furnished to the employer on or before the commencement of employment or when there is a change in status. It is claimed by the employee, and it provides the information the employer needs to compute the correct amount of withholding for the employee. There is a thing called the jurat. The jurat is the thing that starts out with, under penalties of perjury, I certify that this is true, correct, and complete, and so on. So that signature is indicating that when the employee gives that to you, it is true, correct, and complete, and indicates the correct amount of withholding for that employee's situation. Now, the W-4 can also be used to claim exemption from withholding, and the procedure is different for the new forms than for the old ones. This is a picture of the 2019 form, and it hadn't changed for a number of years very much at all. So it's got 3 marital statuses there: single, married, and married but withhold at higher single rate. It's got a box 5 for the number of allowances based on the worksheets or what the employee estimates is what their number of allowances is going to be. A line for an additional amount, if any, that you want withheld from each paycheck, the employee does. And line 7 is about claiming the exemption. And it's not an exemption from tax, it's an exemption from withholding, because the employee does not have enough sufficient income to have to file a tax return, did not in the previous year, does not expect to in this current year, and would expect to have a refund of any income tax withheld if they did have to if they did file a tax return, and then they write exempt in box 7. Nothing else on the form except for their identifying information. So if they indicate a number of allowances or an additional amount to withhold and the marital status is questionable, but if they indicate any of those, then the form is ambiguous. You're not sure what they wanted to do, claim exempt or have something withheld, and so you're going to have them give you a different one or a new one to replace that because it's not understandable. Now, you should not be receiving any of these now. Only the ones that were presented prior to January 1st, 2020 would be in effect. If you get one of these during 2020, you would not be able to honor that as such. So here's a blow up of that. I already went through that, so we're not going to, oh, just the exemption. They need to, yeah, that's there. And the jurat is there. Under penalties of perjury, I declare that I have examined the certificate and to the best of my knowledge and belief it is true, correct, and complete. The employee signs that. And it's not valid if they signed it, didn't sign it, and it's not valid if they make any changes to the wording or any other unauthorized additions or other items. Now, line 6, additional amount, if any, that you want withheld from each paycheck. A question was asked whether that can be a negative number, meaning that they'd want not an additional amount, but a lesser amount. And it doesn't say that anywhere that it's allowed. It doesn't say it's not allowed, but the wording and everything is an additional amount you want withheld from each paycheck, not a reduction. And significantly, one of the, I believe it's Connecticut, has a comparable form for their withholding certificate, and it does allow for, because they use a code for the tax tables rather than some other factor for determining what to withhold, it allows for an additional amount to be withheld from the table amount and also a reduction in the table amount to be withheld based on the code for their marital status and income level. There's some worksheets on the 2019 W-4. These are for the employee. I don't want to get into a lot of detail on this because it'd be time consuming, but they're there. And it's just a worksheet for figuring out what needs to happen. And then they've got an adjustment for 2-earner or multiple jobs worksheet there. Now, the 2020 withholding certificate is a bit longer and it contains several sections. So the first part, step 1, is the identifying information and the marital status. And the marital status has changed here. It is now single or married filing separately, married filing jointly, or head of household. Those are the 3 marital statuses for the 2020. Now, they can complete that part and sign it, and then you will just use the appropriate table, the single or married filing separately, married filing jointly, or head of household table for the appropriate payroll period and withhold the amount indicated on that table for the amount they're being paid. If they need some adjustments to that because of other things going on in their life, the steps 2, 3, and 4 make some adjustments to those. Step 2 is about multiple jobs, and there are some tables in there regarding multiple jobs. This is where either the taxpayer has more than one job, or the taxpayer and spouse each have a job, or they each have multiple jobs, or whatever. But anyway, there's ways to figure out how much additional should be withheld on the highest paying job to cover the differences in the tax brackets, tax rates for the lower paying, the other jobs, and the fact that those lower tax brackets are going to be used more than once. So that is a possibility there. If it's only 2 jobs, you can check the box and do the same for the other job, and this is accurate for jobs with similar pay. So if you've got a married couple and each is making about the same amount of money, you can check that box. And it'll be treated as 2 jobs with about equal amount, and it should come out pretty close. Otherwise, that's not going to happen very much. Now, Remember, you're going to have to be looking at all of this. Now, steps 3 through 4B for only one of the jobs, and that's usually the highest paying job. So down here, step 3 is for the tax credits for dependents and qualifying children and other dependents. You put those amounts in there. Those are the annual amounts, and that total is entered on line 3, and that's the number you're going to pick up in doing your computations for the withholding. Step 4A is for other income, not from other jobs. That's handled with the multiple jobs thing. And a question came up whether the pension as an annuity should go down here or up in the other jobs, and it kind of hints that pensions and annuities and stuff should not go up in the upper part. If you don't have withholding from them, it should go in 4A. If you do, it's kind of ambiguous, but the pensions, the W-4P uses allowances, the one that's currently released, and also uses the pre-2020 marital statuses. So it's not really compatible with this. If the employee is using that, then I would strongly suggest they go to the calculator and get it figured that way. 4B is for other deductions that they claim in addition to the standard deduction, if they have excess itemized deductions or if they have some other types of things such as losses on rental property or capital gains losses and things of that sort, so that the withholding can be reduced to account for those. And then line C is kind of a catch-all for the extra withholding, an additional amount they want withheld each pay period to account for whatever else is going on there. In addition to those other things. Now, those are the things that you're going to be looking at, and that's starting to look like a lot of work, and it is. So there's a place for the employee signature with the jurat, and that didn't change. Okay, this is a multiple jobs worksheet. That's on the W-4, and if the employee wants to work that out, and there are ways to figure out for more than one job. The deductions worksheet section is here. And that is, you know, if your standard deduction is indicated there, and then some other things, that's for step 4B. And then this is the multiple jobs table, and I'm going to show you a situation with that, just showing you the tables. So for step 2, the multiple jobs, here we have 3 jobs, and what we do is we compare the highest paying job and the 2 jobs that are lowest paying and then the highest paying job to the 2 lower ones, and we come up with 2 numbers from the table. And what you want to do is see publication 505 for the instructions on this if you are interested in this. But again, this is the employee's part and the employee's worksheet. So what happens here is you get a total amount of adjustment to make, divide that by, in this case, it's a semi-monthly pay period, divide by 24 semi-monthly periods, and you get $360 additional to withhold for each pay period, semi-monthly pay period, to cover that. And from the table, this is where those 2 numbers came from, comparing those the 2 lowest paying jobs and combining them and then comparing that to the highest paying job. You get those 2 figures being added in to cover it. And what the employee's W-4 is going to look like when it comes in with that computation is it's going to look just like this, except that there will be also the identifying information up at the top. They'll check married filing jointly, and they'll put that 360 in there down on line 4C, and they'll sign the form, and that's all you're going to get. So that becomes fairly easy from your standpoint because you don't have to deal with all those other lines on the W-4, which you would have to deal with otherwise. Okay, there's a W-4 withholding estimator that the IRS has put out, and doggone it, it is actually pretty good. I tried it out, and it does a pretty good job. It's a more detailed process. It asks the employee a series of questions regarding the situation, filing status, dependents, income sources, and so on. And the next page has to do with income details, which is where they put in all their sources of income and the amounts they expect to get and all that. The adjustment details, which are usually deductions, and deduction details, and tax credits. This is each a separate question and answer page, and if the employee answers that they have something, then more questions come up, and it provides a result and a slightly filled out W-4 that is, in fact, fillable by the employees so that they can use that to turn in. And I provided you with an example of this in the handouts. So that handout section is pretty big. If you have trouble downloading it, let us know. We can break it down or at least let you know what's in it. Everything's from the IRS website except the, I think this one that I went through the process and printed the results out to look at. Now, here is the first page. It's about you. It asks for the filing status and number of and if you have dependents and so on. And it continues to expand as additional information is needed for that page. This is the end. This is the results. And it tells you your expected withholding and the amount of the obligation. And so the employee can put in amounts that are expected to be withheld from pensions and annuities and Social Security and things like that if they have withholding on that. They can put in estimated tax payments and all those adjustments, and then it figures out what the employee's rough tax liability should be and how much they need to have withheld in order to cover that. So it tells the employee how to adjust their withholding. And the one I did came out with an amount down at the bottom, similar to the one that was filled out earlier. Okay, exemption from withholding applies only to federal income tax for this W-4. Now, states may have exemptions from withholding also, but the rules may be different from the federal. So the state rules are likely different, and you also, even if they claim exemption from withholding, they're not exempt from tax, you're still going to withhold Social Security and Medicare taxes. Exemption from withholding is only for federal income tax. The W-4 claiming exemption applies only for the current calendar year. It's effective when submitted to the employer, so any withholding prior to that submission is not refundable. You do hang on to that and you deposit it. That's already happened. If they get it to you, if they renew it, if they had one and they renew it before February 15th, then you would not be withholding up to that point anyway. New W-4 is required to continue the exemption. That means that anybody claiming exemption from withholding is going to have to give you a 2020 W-4 to continue that by February 15th. So they got a couple more days to get those in. If not submitted, begin withholding on it based on the last W-4 that did not claim exemption. And if there wasn't one, use single or married filing separate tables as if no entries in steps 2, 3, or 4 on Form W-4. So that's going to be the 2020 W-4 marital statuses and no other adjustments to that table for it. If you receive it after February 16th or February 16th or later, apply to future wages. Do not refund prior withholding for the calendar year on that. So this is what the form should look like if they're claiming exemption. They're going to fill up in steps 1A, which is the name and address, step 1B, the Social Security number, no entries on steps 1C, steps 2, 3, or 4, except that they write exempt in the space below step 4C. And then they fill in step 5. They sign it and date it. So that's how it should look if they're claiming exemption with the new 2020 W-4. Um, okay, obtaining the forms. The IRS will furnish blank copies to the employer upon request. That's so you can get the forms themselves. These would be paper copies. The employer may download forms from the IRS website. The employer may prepare and use a substitute form. The substitutes must be identical to the prescribed form and must provide all related instructions, worksheets, and tables, and must comply with substitute forms revenue procedures. The employer may not accept a form developed by the employee. Now, the forms downloaded from the IRS website, the A copy, which is the filing copy for the Social Security Administration, must be an official form if you're filing on paper, or an approved substitute form if you're filing on paper, and that's because of the special ink on it. Otherwise, you can fill in the forms, the W-2 forms from, well, no, this is the W-4. I'm sorry. I apologize for that. I'm brains crossing here. These are the W-4 forms. They don't have that special red ink, so you don't have to worry about that. They're not filed with the IRS, and they're kept by the employer unless the IRS asks you for a copy. But the employee may not develop their own W-4. Very often they do that on the advice of somebody helping them to be a tax denier or a tax protester, and they're not legal. They do not meet the requirements for instructing you how to withhold. If you go with an electronic W-4, there are some certain requirements, and that's in Regulation 31.3402 F5-1C. You must be able to furnish the IRS with a hard copy. That means that you should be able to print it out. Whether it looks exactly like a W-4 or not, it is not necessarily required, but the hard copy must have the same information as a paper copy. But it need not look like the paper form. And the electronic system must inform the employee that the signature is under penalties of perjury. And if they do an electronic signature on it, it has to be, you have to be able to verify that that is the person actually signing the form electronically. And you have the same record-keeping requirements as for paper, including the jurat that the employee signed. It needs to indicate that that was signed in accordance with the jurat. And the 4-year requirement past the date it was last used and things of that sort. State withholding certificates. Most states and localities have separate withholding certificates because of differences in withholding allowances, marital status, resident versus non-resident. That's very often localities, but sometimes the states have different rates. Allowable deductions and credits. Michigan, for example, has a $1,200 property tax credit that applies to certain individuals, and there's nothing comparable on the federal, so the federal allowances wouldn't allow for that large credit. And exemption from tax withholding may be different. So there are compliance issues in using the federal W-4. Now, some of the states accepted the federal W-4 allowances. The thing with this is that with the change in the federal W-4 form for 2020, this may not hold anymore. So some of the states, Minnesota and Wisconsin, for example, I think Minnesota came up with a form. They didn't have one before. And I'm working from memory here, so I'm not quite sure that that's correct. But I know Wisconsin had one, and they encouraged its use, but they would also accept the federal allowances. Now they will not accept the federal allowances because there are none. You have to put your own allowances in on the Wisconsin form. Now, for several states, the tax is closely tied to the federal tax. Now, these 4 states still accept the federal W-4 for state withholding computation purposes: Colorado, New Mexico, North Dakota, and Utah. Be sure to check before you, just to make sure that things haven't changed. Pennsylvania has not had a certificate because there are no withholding allowances for Pennsylvania, so that's not an issue there. This is a picture of the Illinois certificate, and you can see that even under the old rules, it was different than the federal. It did not have marital status on there. Enter the number of basic allowances, enter the number of additional allowances. That's different from the federal, and then the additional amount you want withheld. And then the exemption from withholding, apparently in Illinois, if you want to be exempt from Illinois with income tax withholding, you must also be exempt from federal income tax withholding. This is the Connecticut withholding certificate that I mentioned earlier, where they have codes for the tax tables based on marital status and income level. And what the taxpayer does is enters the code for the tax table in there, and then has the opportunity to ask for additional amount to be withheld per pay period, or a reduced amount with withholding per pay period. And then also this particular form has the new hire reporting information on it. So this form is intended to be used for new hire reporting for the state of Connecticut as well. State and local forms use the state and locality specific forms because they're often different. Where do you find these? The Bureau of Labor Statistics used to have an excellent web page on that for their employees that was accessible by anybody. I have not been able to find that this year. Something changed. And however, Symmetry software at this particular link does have links to the state sites and various things that you need to know about the state. We may take a look at that again in a minute. But well, here it is here. And this is the federal form is first, and then Alabama is listed, and it shows the forms. And then Alaska doesn't have any withholding tax, so they don't have any forms for that. And then it just lists everything alphabetically. Now, some states have reciprocal agreements. Certain neighboring states or other states may enter into agreements not to tax each other's residents. If that's the case and they provide you, usually it requires the employee to provide a certificate of residency or a certificate of non-residency, so that normally you would withhold state income tax for the state in which the employee performs services. If the employee works in one state, lives in another one, and they have a reciprocal agreement, that does not hold. The employee is only going to pay tax to their resident state, and if they provide you with a certificate, you can then withhold tax for that state instead of the state in which they are working. If you withhold in the state where they're working before they give you a certificate, yeah, that's going to go in. They have to claim that on their tax return unless you can make an adjustment somehow. But when they do their tax return, they're going to indicate they're a resident of a reciprocal state, and they will get a full refund. The only thing this does is it prevents them from having to file 2 tax returns for state purposes. If the employee moves, there's a need to make a change usually. These are the states that definitely have reciprocal agreements with some other state, usually on that list. So not necessarily with each other. For example, Indiana and Illinois both have agreements with Michigan and Ohio and Wisconsin, but they don't have an agreement with each other, even though they're right next to each other. This is the Indiana Certificate of Residence. It does need to be notarized. Not all of them do. The employee fills that out and certifies they're a resident of one of the states that Indiana has a reciprocal agreement with. That'd be Kentucky, Michigan, Ohio, Pennsylvania, and Wisconsin. Let's take a quick look at an example here. Sam is a service technician for an employer with facilities in Michigan, Ohio, Kentucky, and Pennsylvania. Sam lives in Michigan, regularly travels to work on equipment and facilities in each of the other states. Michigan has reciprocal agreements with Ohio and Kentucky, but not with Pennsylvania. Sam's employer will withhold Michigan tax for work performed in Michigan, Ohio, and Kentucky, and withhold Pennsylvania tax for work performed in Pennsylvania. Sam will have to file Michigan and Pennsylvania income tax returns. Michigan will include the Pennsylvania earned income in the Michigan taxable income. So because he's a Michigan resident, all of his income from wherever is taxable in Michigan. but Michigan will grant a credit for the tax paid to Pennsylvania on that income up to the amount of Michigan tax on that same income. So it'd be either the lower of the Pennsylvania tax on the duplicate on the income that's taxed both places, or the Michigan tax that is on income earned in both places. Now, the Pennsylvania tax rate is lower than the Michigan tax rate, so you think that it would be the max would be the Pennsylvania tax, but Michigan has allowances and exemptions against the tax. So those allowances would apply and be allocated across all of his income, including the Pennsylvania one. So even though Pennsylvania doesn't have any allowances, that 3.07 is going to be on the gross. Even though they don't have any allowances, for Michigan purposes, some of the allowances will be allocated to the Pennsylvania earnings, and therefore the amount of Pennsylvania tax that's allowed for the credit might be more than what the Michigan tax is on that same income. So it could go either way. The employee has to kind of watch that. So there's also the non-resident military spouse, the Military Spouse Residency Relief Act. And each state has adopted this. The rules might vary from state to state. In some states, the military spouse is not going to be taxed at all on their earnings. They will all be taxed by their resident state. In other cases, if the military spouse would otherwise be a statutory resident of the state in which they're working, they will still be considered to be a resident and domiciled in their state of origin, as long as that matches that of the military member's state. So there are a variety of rules related to this, that how they qualify for that, but it is important. It keeps them from having to file a tax return in the state where they're working, in some cases where they're not going to be taxed at all, or if they are, they're taxed as a non-resident and not as a resident in that state where they're working and living with their military spouse member. So these would be some of the conditions. This is a form for Indiana again, I believe, and it just tells how that goes on. Okay, Publication 15T, Computing Withholding. Publication 15T provides a whole bunch of tables and 5 withholding worksheets, 7 tables, and I'll show you some pictures, and then I'm going to make a recommendation. And I'm not going to necessarily go through this, but I'm going to show you why I'm not. This is a percentage method tables for the automated system for Forms W-4 from 2019 or earlier. So this is looking different from the tables that we're used to working with from Publication 15. The tables are now in Publication 15T. There was a Publication 15T a number of years ago when there were some changes to the withholding tables in the middle of the year. It's been resurrected. Anyway, it contains the tables. Publication 15 does not contain the tables anymore. So for 2019 or prior forms that are used for 2020 or later year withholding, you're going to have to use these tables. And these tables are for automated payroll systems, so they're kind of complicated. But look at the steps involved and how you're pulling out the different things. You can play around with these if you like. I started to, and then discovered that there's a much easier way to do this, and that's using your computer. It's not a bad idea to know how the tax is computed under each of the methods, but anyway, the thing that's easier to do is to use the income tax withholding assistant for employers. Now, this is going to be useful for small employers where you don't have many employees. If you got many employees, you're probably using software, payroll software, or you're using a third-party provider, in which case they've got these calculators embedded into the payroll, and you're going to be doing that. You can use this to check to make sure it's being accurate, and it's not a bad idea to do that. but this withholding assistant for employers is really good. It covers both types of W-4s that you might have, the prior year W-4s and the 2020 or later W-4s. You select the type of W-4 that you have, and then it lists the information you need to put into the template. It's an Excel spreadsheet, actually, that you need to put into the template to calculate the tax. So we put in, I put in this person is paid every other week. That's biweekly, every other week. Yeah, biweekly, biweekly. The employee's taxable wage or salary for that paycheck, and the type of W-4. This is before 2020. Filing status. Again, you have those three filing statuses: married but use single rate, married, and single. Now, there's a little white box there over in that black section, and that box can be moved around to get it out of the way when you're using the calculator. So just because it pops up, anytime you click on one of those boxes, it pops up and tells you what to put into that field. So we picked married but single rate, 2 allowances, and the amount to be additional amount to be withheld of $15 per pay. And it calculates $190 to withhold for federal income tax on that paycheck for the $2,000. We have the same employee in situation, but a 2020 or later form, and here they select single or married filing separate, as it is. Did they check box C? No, so they only have the one job. The amount of earnings is the step 3 amount is $2,000. This person has one dependent child, one qualifying child, and has some other income of $10,000 and wants extra withholding of $15, and it computes withholding at $196 for that. So the table on the left is for the 2020 or later. If you select before 2020, it'll go over to the right side for the input information, and the stuff up the top, pay frequency, taxable salary, or wages, and the version all remain the same up there, and then the output comes up at the top. So for small employers, this is a good idea. What you should do if you are a small employer and using this is create a spreadsheet like this. You download it from the IRS website, and you create one for each employee. You put in that employee's information based on their W-4, which W-4 they have, what they've claimed on that W-4, and their pay frequency. And then all you pretty much need to do is put in the taxable wage or salary amount for that paycheck, and it should calculate the amount of federal income tax to withhold for that paycheck in either case. So that makes it a lot easier if you're doing a spreadsheet type thing. If you've been using an Excel spreadsheet to compute the withholding, and that would be all of the withholding, including the Social Security and the Medicare, and you've been looking up the withholding and the wage bracket tables, or doing some other calculation off of the spreadsheet, you can still use that spreadsheet for computing your overall paychecks, withholding, net pay, and all that other stuff. But this additional work Excel template will give you the calculation for the income tax withholding for each employee, as long as you have a separate one for each employee. I'd looked at maybe trying to put them all in one spreadsheet, and that wasn't going to fly at all. It just didn't seem to want to work that way. It's well protected, I believe, so it can't be altered or adjusted. Okay, moving along. Non-resident aliens. There's a Notice 1392, which is the supplemental W-4 instructions for non-resident aliens. It is not updated as of the last time I looked. There's a draft form at that web page, or there was again the last time I looked, and I don't remember if I looked before this, but I know I looked at the end of January. They advise you to see Section 1 of Publication 15T, and you provide the employee with a Form W-4. They must enter their Social Security, not an individual tax ID number. Remember that in order to be eligible to be an employee in the U.S., they must be eligible to work in the U.S., and if that's the case, they can get a Social Security number. If they are not eligible to be an employee in the United States, and they need a tax ID, they can get an individual tax ID number, an ITIN from the IRS. They check the single box regardless of their marital status. They may not claim child tax credit or other dependent credit except for certain countries and other situations. And they enter NRA for non-resident alien in the space below step 4, where we did the exemption before, on the W-4. And they may also request additional withholding if they want. They may not claim exempt. There are 2 tables for the additional amount they need to have added to their wages for purposes of calculating the withholding from the tables. This additional amount added to the wages is not wages. It's an adjustment to the tax table. Instead of adjusting the tax table directly, they adjust the employee's wages. So it depends on what pay period and what type of W-4 you're looking at. If it's prior to 2020, it's Table 1. If it's after 2020, it's Table 2. And so let's look at the semi-monthly amount. $337.50 is added to the employee's gross taxable wages, income taxable wages, for purposes of calculating withholding only. It's not added to the W-2 or anything else, just to the wages for the pay period semi-monthly. If it's after 2020 W-4, the amount is $516.70. And then we take a look at the calculator here. In this case, the employee is paid $2,000, and we add that $338 to the $2,000 for purposes of doing the calculations. And they claim single with 1 allowance, and we get $265 in withholding. If it's an after 2020, we add $517 to the $2,000, put in single. Did the employee check the box and see? No. Amount of federal withholding, $265. So it is consistent. We got the same amount for the same salary using the different tables in the right place, and so we got the correct amount of withholding for that employee for that income for 2020. This is just a screenshot of the top of 1392. Again, it had not been updated since 2018 October, and they are working on an update, but most of the instructions in there are correct. It's just what happens with the W-4 otherwise. Form 8233 may also provide an exemption from withholding on compensation for independent and certain dependent personal services of a non-resident alien. That's a fancy word for dependent would be under employment. But if they're exempt under a tax treaty for part of it or all of it, they can fill that form out, and that will provide you with information you need there. And this would be for dependent personal services. This would be employment performed in the U.S. or non-compensatory scholarship or fellowship income and personal services income from the same withholding agent. Otherwise, you're going to use Form W-4, or if they're a non-resident alien, a W-8-BEN. And see Publication 519, U.S. Tax Guide for Aliens. Some of these things that I'm mentioning here, when I mention publications, I don't think that's one of them, but some of the publications that I mentioned here are in the handout. Okay, alternative withholding methods. These still apply. These are all still good. They're described in the wages, the tax code and regulations, and one is described in a revenue procedure. So these work the same way. It's just that what you're using as gross wages comes out a little bit differently. The tables are still used the same. So annualized wages just simply takes it's the reverse of what's going on otherwise. It takes the amount of pay for the pay period, multiplies by the number of pay periods, comes up with an annual amount, computes the tax on the annual amount using the annual table, and then divides by the number of pay periods in the year, and that gives you the amount to withhold from the current pay period. That's what the tax tables do with the different pay periods. Average estimated wages, that's quarterly wages. This works well where there's fluctuating pay each pay period and within the quarter, and you can reasonably estimate how much it's going to be, and you estimate the quarterly amount, divide by the number of pay periods in the quarter, compute the tax on that, and withhold that amount each pay period, regardless of how much is actually earned during that pay period. And if you, it's obvious that it's not going to be correct at the end of the pay period, you adjust it so that it comes out pretty close, and then the final pay of the pay period, you adjust to what the quarterly withholding should have been based on the quarterly table for the total quarterly amount. Cumulative wages requires the request of the employee in order to use that, but that takes the cumulative. It requires the same pay period. The employee be paid for this, say, biweekly every pay period during the current calendar year. The employee was paid biweekly or semi-monthly or weekly or whatever the pay period is. It has to be the same pay period for all of the payments. You take the year-to-date wages, including those to be paid during the current pay period, divide by the number of pay periods to date, including the current pay period, to get the average amount per pay period, compute the tax on that, and then multiply that by the, back up a second, that's the average. Cumulative wages, you compute the cumulative amount. No, that's correct. You get the average, compute the tax on the average, multiply that by the number of pay periods. That gives you the total amount, cumulative year-to-date withholding that was required. Subtract any prior withholding from that, and that's the amount to withhold from the current pay period. Prior year employment method works well with students who had not had previously had a job or are starting up a job after some low-paying jobs, and they have a period of non-employment. And what it does is it takes the current period of continuous employment and accumulates the pay, adds it up, computes the amount of withholding required for the number of pay periods since the last period of continuous employment, and it reduces the amount of withholding, and then it gradually increases toward the end of the year, but it reduces the amount of withholding on that because the person wasn't employed for the entire year. So it makes it a little closer to what they actually should have. Supplemental pay is pay that is in addition to the regular pay, and this is not the same as regular pay for Fair Labor Standards Act purposes, which is for purposes of computing overtime compensation. But this regular pay is their regular hourly pay or their regular periodic salary or day rate or whatever it is. And then this is additional pay like bonuses, commissions, severance pay, things of that nature, non-cash fringe benefits, and so on. There are three methods at the federal level for this: the aggregate method, optional flat rate method, and mandatory flat rate method. Aggregate method, what you do is you combine all of the payments made during a particular pay period, or you combine the supplemental pay with the regular pay if they're paid at the same time, compute the tax on the total amount, and then subtract any pay, tax that is to be withheld or was withheld from the regular pay, and then the difference between the total tax computed on the aggregate amount and the amount that was previously withheld is the amount to withhold on the current payment, the supplemental pay. Optional flat rate method applies a flat rate of 22% to the gross supplemental pay. The regular pay is going to be withheld under the regular situation. No other rate may be used for that, 22%. And then the mandatory flat rate is the highest rate, currently 37%, and that applies to the cumulative supplemental pay for the current calendar year for that employee to the extent that that cumulative supplemental pay exceeds $1 million. So that excess over $1 million is subject to that mandatory flat rate. Effective dates, your initial W-4 should be acquired at the time of employment. The employer is required to request it. It's effective with the first wage payment after you get it from the employee. If you don't get one from the employee before you make that payment or any other payments, you withhold it single with no withholding allowances or exemptions, and that's valid, effective until the employee submits a new valid form. The employee may be subject to $500 fine for inflated claims. This is the old rules for the prior to 2020. Let's see. That would be the same. It says withholding exemptions or allowances there, but for the new form, it's going to be you withhold as if the single or married filing separate table without any entries in any of the other steps. Any changes that the employee wishes to make to the withholding amount must be made on a W-4, and if they were subject to withholding under a prior year W-4 and they want to make a change, it's going to require the new 2020 form for that. The new form is effective for the first payroll period ending on or after the 30th day from submission of the new W-4. The employer may make it effective sooner. And you've got must versus may changes. Must changes. Any changes to the employee's situation that would increase withholding, the employee must submit that within 10 days of the change. And if they're no longer eligible for exemption from withholding, either one of those. May changes that decrease withholding, the employee can submit those anytime. If they're incomplete or improperly prepared, for example, the name is not right, or there's ambiguity in that they have exempt plus withholding instructions, or it's unsigned, or they entered a percentage, or they entered a flat dollar amount to withhold other than the additional amount, that's going to make the W-4 incomplete or improperly prepared. If possible, take a look, ask the employee to show you their Social Security card. They may not be able to, that's okay. But if possible, take a look at it. Also ask if you can take a photocopy of it. This was brought home to me, not with a payroll situation, but with a tax return situation. We had a client who had been filing paper returns for the 5 years he'd been with us. The young guy just out of school for the last 5 years, first job, and we filed the return electronically, and it got kicked back for a name number mismatch. I went back through, looked at everything. Everything matched. The W-2s matched. The prior year returns matched. Everything matched. So I asked him to bring in the Social Security card to see if there might be some other problem. And I looked at the Social Security card, and it looked like it was the same and matched. So then I asked if I could photocopy it, and took a photocopy, and the grayscale shading on the photocopy revealed that the colors shading on the Social Security card obscured one of the digits so that it looked like an 8 when in fact it was a 5, and he had been using the wrong Social Security number all those years. So there could be something like that. And sometimes that shows up with a photocopy. Anyway, provide the employee with line-by-line instructions for the W-4, or you can provide them with IRS Publication 505, which I think is up to date now, but it wasn't the last time I looked. Or your own simplified version, as long as it provides the template letters. I'm sorry, as long as it provides all of the tables and instructions, or you know, the tables that they need to use and the worksheets that they need to use. You can have template letters for this. if you get a mismatch in doing the TIN verification, you can send out a template letter saying, we tried matching your name and number to the IRS system. We got a mismatch. Please verify that your number is correct, or bring in your Social Security card so we can verify that we've got the correct information, and so on. And communicate to employees that if forms are not valid or they're not complete or correct, they will be returned for correction. Invalid forms contain an unauthorized change or addition or modifications to the jurat, or the employee indicates that it is false by the date the employee submits it. If they've already submitted it and they're going, it was not true, you're still with it, but because they signed it under penalties of perjury. But if they indicate that it's false before they give it to you or by the date they give it to you, then don't honor it. If it's invalid, do not use it to compute withholding. Inform the employee it's invalid. Ask for another W-4. And if you don't get another one, withhold based on the latest, earlier valid W-4. And if first paid wages in 2020, including a rehired employee, withhold as if the employee checked single or married, filing separately, and make no entries for steps 3, 4, or 5 of the 2020 W-4. Used to be when the W-4 made certain claims, you had to send it into the IRS. That is no longer true, has not been for some time. You send it to the send them a copy when they ask for a copy. It's no longer sent in based on claims on a W-4. This can change. States vary. Some states still require that if the W-4, the state W-4 makes certain claims, that you send it into them. Record retention, you want to retain a W-4 at least 4 years from its last effective year. So 4 years from the end of that last effective year. So you could have several W-4s on file for a particular employee if they've been changing them. You may want to make sure you file them when they become non-effective. Put them in a file that's tagged for destruction 4 years after the end of that year that it went into the file. And also there's some special rules for successor employers. But a successor employer who qualifies and is using those W-4s has the same record-keeping requirements as the predecessor did with respect to those W-4s that the successor inherited. Lock-in letter. A lock-in letter is a letter from the IRS where an employee has had withholding or had issues with their amount of income tax being withheld and paid in, and it specifies the marital status and withholding instructions for that employee. When you get one of those, you provide a copy to the employee within 10 business days of receipt. That's so the employee has time to contest it. And that is if the employee is employed by you as of the notice date. Now, that includes certain seasonal employees who might not be employed at that time, but will be employed again in the future, so they're not employees, they just are not currently working. And the effective date for rehires within 12 months of the notice date. So effective for rehires. So if you get a lock-in letter for somebody who is laid off, if you rehire them within 12 months of the notice date, then it applies to them. If you get one of these lock-in letters and the employee doesn't get it modified, in which case you get a modification letter from the IRS, you disregard any subsequent W-4 that results in less withholding, but if they give you a W-4 that results in more withholding, you must honor that new W-4. Now, that doesn't cancel out the lock-in letter, so the employee can't come back and submit a new W-4 for a lesser amount. The lock-in letter sets a floor below which the employee cannot go, so it's still effective. Lock-in letters effective for rehires within 12 months of the notice date. An electronic system cannot allow override. This is the W-4 system. Cannot allow an override to decrease the specified withholding rate. So if you've got an electronic W-4 system, you have to make sure that it has a lock-in for the lock-in letter. The employee must contact the IRS to claim exempt or reduced withholding rate specified. They can do that. And for lock-in letters received before 2020, continue to withhold based on the instructions in the pre-2020 lock-in letter until you receive a release or modification notice or the employee provides a new W-4 that results in more withholding than the results from the notice. The IRS matching process. The W-4 is the key to compliance here. You're using the information on that W-4 to verify that the W-2 is going to go through without a mismatch on the name and number combination. It provides, the W-4 provides you with a name-number combination, and if it's incorrect, it can lead to notices and penalties. For penalty avoidance, you want to solicit that name and number, usually by using the W-4. Verify that information using the Social Security number verification service, free from the Social Security Administration. You do have to register for it, but it's available. And also make sure that you follow the procedures for reasonable cause for having a mismatch if you end up with one. For W-2s, Social Security number solicitations, solicit that from the employee at the time of hire. Form W-4 may be used for the initial solicitation. Retention of the W-4 in the employer files, records, and the employer records documents that initial solicitation, and ask to see the Social Security card. They don't have to provide it, but ask to see it. Now, the I-9 is not sufficient. I know that if you're an E-Verify employer, you do have to put the Social Security number on the I-9, but that is for a completely different purpose, and the I-9 is not necessarily something payroll people should see because it contains potentially discriminatory information. So that I-9 is restricted, and the payroll people should not be using that to get the Social Security number. If you don't get the W-4, send out some solicitations. This is a procedure for 1099s in particular, but it doesn't hurt to do it for the W-2s. It shows that you made an effort to get the correct information. So if they did not provide you with a Social Security number in response to your initial solicitation, and by the way, if they don't provide you with a Social Security number, that does not give you a reason not to pay them. You must pay them under labor law. So you got two different laws in effect here. So even though they don't give you the information you need, you still have to pay them if they worked. So you could end up in a situation where you've paid somebody and have to issue them a W-2, but you don't have their correct name or their number, or don't have a number at all for them. Anyway, for the annual solicitation, you send in the first annual solicitation out by December 31st of the calendar year of hire. If you still don't get it, send a second one by the following year, and you can use the Form W-4 for the annual solicitations. And that says that you at least made an effort to get that information, and that can establish reasonable cause for failing to have it. If they don't provide it to you, that's not necessarily your fault unless you didn't ask for it. If you receive a 972CG notice of proposed penalty or an incorrect Social Security number, send out those solicitations again. You can explain what happened on that notice, and the penalty can be waived. It's just a proposed penalty at that point, and it's noticed to you that there's a name-number mismatch, and you need to find out what's going on and have the employee corrected if you can get it corrected. Reasonable cause is established where the initial solicitation was made at the time of hire, and you use the number the employee provided. So even if it's in the incorrect number, if that's all you've got, that's what you use. The penalty notice triggers a first solicitation, and a second penalty notice triggers a second. To establish reasonable cause, it is the solicitation that's important. Initial solicitation and two annual solicitations establish reasonable cause, and the employer may use the Social Security Administration verification service. It is not required, but that gives you a heads up where there might be a problem, and you may be able to head it off before you get that penalty notice. Now, these SSA mismatches from that verification service are not IRS notice, and solicitation requirements are not triggered by it, but you may want to obtain the correct Social Security number information before submitting the W-2. If you get an SSA no match letter, the SSA has a sample letter to send to the employee, and that should be at that website. And this is a copy of it. of a solicitation letter. We verified the following information with Social Security on this date. According to Social Security, the information does not match their records. You should check to see if it's correct and so on. Matching process is not 100% accurate because it only involves 4 characters for the name match. So for individuals, it's the first 4 letters of the individual's last name. If it's a hyphenated name, it's the first 4 letters of the first last name. And I understand that if it's isn't hyphenated, but it's still 2 last names, it's the first 4 letters of the second last name. The SSMVS is a free service, and it allows registered users to verify names and Social Security numbers against the SSA records. It requires registration. Individuals register. They must be employees, and the employer gets notification and validates those people for access. This is the picture of the information for it from the SSA website. Again, this changes periodically. You can submit 10 names and Social Security numbers per online session. There's no limit on the number of sessions. You can upload files that are much larger and usually get the results available the next day, in the next government business day. Use it only to verify Social Security numbers of current or former employees for W-2 purposes. It's not for verification of potential new hires, contractors, or tax return preparation, and there are serious fines for using it for those purposes. They used to make it available to banks for a $5,000 fee, and it doesn't look like it's available to them anymore. W-2 penalties for missing deadlines. You need to provide copy A to the Social Security Administration for 2019 returns due in 2020. The accelerated due date began with the 2016 returns due in 2017. Copy A is due to the SSA by January 31st, and that is true for 2021 and so on, whether on paper or electronic. Prior to 2015, for 2015 returns due in 2016, the copy A was due to the SSA by February 28th if filed on paper or electronic March 31st. So that due date has been accelerated, and because of that, there's a potential for some more errors and so on. So penalties for late filing or furnishing: failed to file timely, failed to include all required information, included incorrect information, filed on paper when electronic was required, failed to report a tax ID number, reported an incorrect tax ID number, or filed paper returns that were not machine readable. And there's also a separate penalty that it looks exactly the same for failure to furnish the correct information returned to the employee by the due date. There are 2 separate penalties. The penalties are now indexed. 2015, they had been at the same level for a number of years and included discounts. Originally, they were $50 per return, and then they changed that, put in some discounts for early correction. And so earlier on, it was $30 per return if corrected within 30 days, $60 per return. That's per W-2 if corrected before August 1st, and after August 1st, $100 per return. And if there was intentional disregard, it was $250. Starting in 2016, at the beginning of 2016, they upped the penalties. They are indexed. The per form penalties are rounded down to the nearest $10. The maximum penalties are rounded down to the nearest $500. So you can see that some of those started increasing immediately. The after August 1st penalty went from 250 to 260 by the end of 2016, remained at 260 until 2019 when it bumped up to 270, and for 2020 it's up to 280. Similarly, the intentional disregard has gone up every year except between 2017 and 18. It's now up to 560. The within 30-day penalty has not increased. That's remained at 50, but I suspect it's getting close to being increased pretty soon. As soon as it crosses that $60 amount, it'll go up to $60. The before August 1st remained at 100 until 2020. It's now at 110 per form. So those can add up quickly. You don't want to have penalties on that stuff. You want to avoid that if you can. How do you avoid it? Reasonable cause is the big one, and we already talked about that briefly. Reasonable cause is you did what you needed to do to make sure you were in compliance. it was due to conditions beyond your control, and the IRS example of that is that the employee didn't provide you with the correct number. And also that you did your due diligence, you made your solicitations and so on, and attempted to get the information. Let me see if I've got that. Nope. Okay. There's inconsequential error. Omission is one that does not hinder processing. And in the case of a W-2, an error in the tax ID number, payee surname, or any money amount is never inconsequential. Addresses are probably inconsequential because the SSA doesn't want you to file a correction for an address if the employee address is incorrect. And you can actually take the W-2 that got sent back to you for an incorrect address, put the correct address on an envelope, put the same W-2 back into that envelope and mail it out, and that works. There's a de minimis error rule for corrections, few of the greater than 10 or 1% of the forms filed. I think that's incorrect. I think it's 1/2 of 1% of the forms filed. But in any case, that's a lot of forms to beat the 10. Be 1,000 if it's 1%, or 2,000 if it's 0.5%. The forms had to have been filed timely and contain incomplete or incorrect information, and corrections filed by August 1st. So if you're doing whatever you need to do to be in compliance and you have just a few problems there, you can escape penalty for doing the corrections. There's also a safe harbor for certain money amounts. These may be considered de minimis, and this was implemented with the accelerated due dates because it was expected that we'd see, with people hurrying to get the forms filed, that there might be more errors that were not detected before they were filed, particularly where the employee notices something, and for so small dollar amounts. If the single dollar variance is not more than $100 and a single dollar variance for withheld tax is not more than $25. If the safe harbor applies, the employer will not have to correct the W-2. The W-2 is treated as correct, filed with all the correct information. And however, the safe harbor does not apply if the employee elects to have the employer issue a new W-2, a corrected W-2. Now, what I would do, because if you rely on this and rely on the payee coming in and saying, I want you to fix it, you have to fix it within 30 days, file within 30 days, provide the copy within 30 days, and you have to keep records of that election. And if the employee revokes the election, you have to keep records of that. And you have notification requirements as to notifying the employees that they can do that and how to do that. And there are questions as to whether it applies to prior year W-2s or subsequent W-2s, year W-2s, and so on and so forth. So my recommendation is that if you voluntarily make the correction, when you detect a correction, just go ahead and voluntarily correct it without having the employee have to ask you to do it. You avoid all of that other hassle, and you're doing something you would end up having to do anyway with it, and you get a correct W-2 that way. It's just, it will still be treated as if you have reasonable cause if it falls within the exception, or it would have fallen within the exception, but for the fact that you made the correction or the employee asked that the correction be made. So it probably is going to be easier just to fix them when you find them, and then you don't have to worry about it. Reasonable cause, not willful neglect, acted in a reasonable manner both before and after the failure occurred, and significant mitigating factors. This would be a history of filing correct information returns. And so if you've been good and all of a sudden something goes wrong, they're not going to hit you real hard. That's the idea. Failure due to events beyond employer's control. The payee did not provide the correct ID number in response to request, and you took steps to avoid the failure. That includes the initial solicitation and, if required, an annual solicitation. Now, IRS Publication 1586 is in the handout. This has the reasonable cause regulations and requirements for missing and incorrect names and TINs. Also in the handout, there is Publication 15T, some selected pages from Publication 15, copies of the new W-4, and a few other things as well. So anyway, it is now time for your questions.